So looking at, obviously starting one of the modules that you're going to be studying under the IFA Direct, acquiring or getting the IFA Direct membership. So this particular module that we are starting off today is financial accounting. And just to give you a bit of a brief overview in terms of how we're going to cover it, what are the main aspects of this particular unit. This unit is basically related to understanding, why we need to do or create reports, essentially. And some part of this would be to look at understanding the background in terms of why accounting and accounting, what is accounting, what are accounting practices, what are various standards, how do we use them in our day-to-day lives, why is it important in terms of financial decision making, and a subsequent unit of this that we will hopefully, if some of you are doing, would be financial reporting. So I'm not going to go into reporting, but there are various reasons why reports are generated through the process of financial accounting, and then reporting side of it allows managers, members in terms of different types of stakeholders to look at making decisions. This particular unit has about 3 learning outcomes in terms of coverage. So we're looking at about 3 sessions to cover the indicative content which is given in this unit, so that it helps us understand what is financial accounting, what are accounting standards, what are the various standards that we look at in the UK and European region, and slightly compare them, just for the sake of knowledge, with US GAAP standards, and then also break them down into palatable chunks of looking at understanding why regulation is required, which is what we're going to cover today in today's session. So regulatory framework and why is it required? Why is it important for financial reporting? Why is it important to have standardization across so that all businesses, companies which produce some sort of financial data or are required to produce because of the various regulations in different countries, what kind of reporting they need to do, and why this becomes an important discipline or an important factor in producing standardized piece of accounts. The second one would be looking at not actually preparing, but we are going to be looking at, some part of it we'll pick up accounts, of companies, maybe for a sample or an example from Companies House, look at how the accounts have been prepared, and then try and interpret, the accounts from a point of view of looking at the cash flow statements. That is going to be learning outcome 2. And the third is going to be looking at understanding the, credit control policy. So we'll be looking here at various things like, what are the organizations which maintain or provide us credibility scores? Why is it important? What are the legislations and the role of the Financial Conduct Authority? And sometimes when we look at credit control policies, when you look at purchasing, when a business looks at purchasing, if they issue an invoice and they offer some sort of or get some sort of a credit, then what are the various responsibilities and the detailing of why it is important to run a business is something that we look at in learning outcome 3. So we are going to be basically looking at starting off with looking into some of the fundamentals today of financial accounting, and start off with learning outcome 1. And I've got a couple of slides that I've prepared, which will take us through this particular learning outcome 1 and some of the assessment criteria. So I'm going to start off with a very basic video, which basically would set the grounds in terms of helping us understand some overarching terms which we will be using during the course of our discussion, in the learning outcome 1. So let me play that video.
Financial accounting is...
Be able to see the screen and hear the video okay?
Yeah.
The process of gathering, recording, summarizing, and reporting financial data relating to a business. The ultimate goal is to accurately report the financial picture and performance of a business at a certain point in time and over a certain period of time. The product of financial accounting is a financial report that contains various statements and explanatory notes. The statements include the balance sheet, the income statement, and the cash flow statement. Explanatory notes follow the financial statements to explain or clarify issues such as the inventory method used, changes in owner's equity, contingent liabilities, and any other material line items in the financial statements. In the United States, financial accounting is done in accordance with Generally Accepted Accounting Principles, GAAP. Internationally, financial accounting is performed in accordance with the International Financial Reporting Standards, IFRS. GAAP and IFRS standardize financial accounting so that the results are comparable between different companies. Financial accounting is best performed by highly trained accountants who have passed rigorous tests to certify their competency. In the United States, such accountants are called Certified Public Accountants, CPA. In Canada and Great Britain, these accountants are called Chartered Accountants, CA.
So this gives us a bit of a very quick overview in terms of, why and how do we look at financial accounting. Now, what I will do is basically get into some key terminology to put this into a bit of perspective. Now, when we talk about financial accounting in general, what we are looking at here is some regulatory frameworks which are required to be able to produce some standardized financial statements. And these could be statements like cash flow statements, balance sheet, profit and loss accounts. And when these statements are produced, they follow certain regulatory framework or standards which have been set, which allow them to be interpreted in a way which either investors, when we talk about different stakeholders, shareholders, investors, board, employees and staff and regulatory bodies are able to understand and interpret them in a very same way, or they're all basically singing from the same book. So when we look at some of these records which are produced, they basically look at being recorded when we look at certain transactions, so they are recorded in a certain particular fashion, which allows them to be used at a later stage to produce some statements, and these that in some stage can be interpreted by people who need to have access to this financial information or need this financial information, say, for the purposes of decision making. So when we talk about businesses, organizations, charities, different types of concerns which are required legally to produce some statements or accounts, they would follow this particular system to create, record, and then publish these statements, which then can be used for various purposes. Now, when we look at basically some background in terms of why financial accounting came about, we go back just a bit of a history. This was first proposed by Luca, an Italian person, and in 1494 he basically created what is called the formalized double entry system. And he basically necessitated that most companies, or at that point in time, obviously there were nothing like companies, but any sort of transactions which were recorded, they were recorded in the form of, when money was exchanged, they were recorded in the form of cash or credit. And obviously people recording it were today what we call them as accountants, but maybe in the past they were just people who were basically recording some sort of these transactions, and they recorded them using, obviously paper and books. So there is some bits of origins that we see of why, this system of double entry that we'll come across in financial accounting and how it works is important, because the origins of this is something that we see in the 15th century when, the mathematician created a system of recording transactions twice. Now, double entry system that we look at is basically, I would say, the foundation of, what we see in financial accounting. Now, all this when we look at double entry, essentially is not normally done on paper nowadays, because it's used and done using various financial softwares, and the softwares are able to manage it. So, but in order to understand why financial accounting and how these statements are developed, it is important for us to know from the beginning that this system is based on what is called double entry system. So double entry would mean essentially not just merely from a point of view of tracking, but an entry which creates a debit or an entry which creates a credit. So essentially, every transaction, if I go out to the market and I say, for example, if I buy something as a company or an organization, if you purchase or release an invoice, then at some stage when you're paying for the invoice, what is happening is you're creating If you're paying for it immediately, then you're creating a debit. And when the asset or the product comes in or the service that you're utilizing and has some value to it, you'll also create, a credit. So there are always two entries to, every transaction. And that is why this is called the, double entry system. And it is the basic concept that we use in terms of recording any transactions that we do primarily from a company standpoint of view. Now, when we look at, let's say, the double entry bookkeeping system, there are 5 different accounts that we normally look at. And when we talk about these 5 accounts, we basically look at these accounts as, or 5 different ledgers, which basically would be created in terms of recording these accounts. And they would be related to, assets, liabilities, you have equity, revenue, and cost. So anything which a company acquires and is a physical or some sort of a resource which basically the business can use or dispose of in the future would be called asset. Something wherein you owe, say for example, when you look at companies owing money, or if you're borrowing money in terms of taking out a loan, if individually people take out a loan, if you spend something on your credit card, until the day the statement, that particular money is settled, that will still be a liability with that particular person or that company. So liabilities are tending to be resources that you acquire and you have to pay for over a period of time, or they could be basically, resources or infrastructure or assets that you make or acquire, but have to be paid for because they've been bought initially through borrowed money. Equity could be something wherein you put that money, which is your money. It could be savings. It could be, if we look at the business, it could be capital reserves. It could be a bit of overdraft, which I would consider equity if it's for short term. But generally, it is capital which is residing in the bank and it is liquid. It's something that can be used by business almost on an instant or an immediate basis. And then we also look at revenue and cost. So revenues are basically from a point of view of recording transactions when money is flowing through the business over a given point in time. You look at revenue. So when we talk about how much how much is the business going to accrue in terms of say in the month of March, sometimes what you will look at is referring to that as a point of reference would be revenue. So how many invoices have been issued? What is the outstanding? So basically, you're looking at referring to what is the term called revenue. What is the business going to generate in terms of money? And that would be basically a revenue. And when we look at costs, the costs would be expenses. Basically, the costs which are being spent in order to derive that revenue, in order to get that revenue. So if you look at a sales organization, costs which are spent in terms of communication, travel, maybe some sort of business expenses, which could be things like entertainment and other bits, would be costs to get that business. So revenue and costs tend to be, also associated with bookkeeping. And in those cases, what we look at is the moving or flowing of money through the business until it's realized would be termed as revenue, and the expenses would be the money which the company or the organization is actually spending to achieve the revenue would be termed as, the term which is revenue, which is money required to generate something. For example, in some cases, if you're looking at buying a piece of machinery, which could be for the company, that in some cases that machinery will generate some revenue after the initial cost when you purchase that asset, because you're purchasing it maybe through savings of the company, or it could be part of that being put in terms of company putting the money and part of it is being borrowed from the bank. And over a point in time, the machinery which allows the creation of output of certain products would then generate certain amount of revenue. And what you'll do is calculate that cost of asset basis, what it produces over its lifetime. So if you look at a production facility, if you end up buying, say, if somebody's setting up, say, a business like or taking up a franchise of Greg's, there's a bit of infrastructure that they're requiring to put into the shop, things like ovens, dressers, other bits. And what happens is over a point in time, the assets which have been used to produce or store some of the inventory which is sold to customers will release, help you realize revenue. And that revenue would essentially pay off some part of it as money which has been borrowed by the bank. to buy those, and in some cases it will be used to leverize revenue or profits, which you will book into the accounts. Now, one of the very basic things that we look at when we talk about financial accounting is we look at this accounting equation. Now, in terms of the various transactions which take place, we normally look at liabilities, and we look at this assets, the basic bit in terms of when you buy something, and if that is going to be say a resource or an infrastructure which at the end of the day the company will utilize, that will be termed as asset, but the asset will be a combination of some liability and equity. So again, going back to the example which I said, is if you end up buying a piece of machinery, that will become an asset because that is something that the company can use to sell in the future. That asset actually depreciates over time. What that would be doing is that this asset would essentially be looking at being bought by a combination of some liability, which means maybe some sort of a loan which the company has taken out or has borrowed money essentially. And in those cases, then, and apart from that, what you'll have is your own equity, which is, the money which the company has invested. So when we look at asset, the cost of that machine would always be equal to liability, which is the money that you've taken out, loan that you've taken out or borrowed, and the equity, which is the money which the company has put in. So the accounting equation side of things is quite important because when we look at double entry system, we use the accounting equation to record the transactions, and you record them as when you buy something, if it's an asset, then what is the asset equal to? A combination of liabilities and equity. It could be that in some cases you buy the asset straight away outright, which is without taking out any loan or without borrowing any money, and that would mean the company is basically investing, equity in order to be able to buy that, or using capital reserves that they have in order to buy a particular asset. But in most businesses which look at running, from a point of view of maintaining their cash situation, you would generally see that businesses sometimes look at taking out, or buying large pieces of assets, infrastructure, machinery. It could be, say, office premises. They would always have a combination of this equation, which is assets equal to being liability plus equity. Now, one of the forms of financial statements that is produced is going to be a balance sheet. And a balance sheet would look at having three accounts. So it will be asset, liability, and equity. And when we look at this accounting equation, it also becomes important when we look at the concept of producing balance sheets, which basically describe the financial position of the business as on a certain date. So when we look at, when I say at the end of the year, the companies are required to produce a balance sheet that describes the position of the company's financial side of things as on that date. And in most companies in the UK, if you look at, we generally see the accounts being done, from a point of view of when they were registered at Companies House, and obviously a full year down the line, at some stage, the accountants or the software would be used to basically calculate or derive certain statements, and they would be income statements, profit and loss account, and finally producing a balance sheet which will depict a picture of the company's financial, position as on that particular date. And this would comprise of two sides of, in terms of producing the statement, and that would be assets and liability. What the company has and what the company owes would be depicted in what is called the financial position when we look at balance sheet. One of the other forms of statement which businesses also produce and are required to produce sometimes to look at ongoing, basis of how the business is doing, or in some cases, management would want to look at what is the statement or condition of the business at any given state. Sometimes what you look at is they will look at producing what are called income statements or cash flow statements, and these statements will primarily be showing what are the revenues the company is accruing, what are the costs the company is spending in terms of accruing those revenues, and whether the company is in red or in black. That means, is there sufficient money coming in, or is the company spending enough money to be able to derive that revenue, and is it spending too much, which is leading to losses, or is it spending just about enough so that the company is able to break even and also at some point in time, make profits from it? So when we look at income statement, the primary purpose of the income statement is to show how much money is coming in into the business, how much of the money is going out of the business, and if the balance of that is positive, then it shows that the company is making money or generating profits. And if the balance of that is negative, that means it shows the company is actually racking up more costs than what is required to be done. And in this case, we would look at income statement to ascertain whether the company is making business, the company's business is making profit, or is it making losses. And this is a statement which basically looks at money coming in and money going out on the basis of accruals. So when you issue an invoice, the invoice would basically be issued to a customer, but at some stage when the money actually is realized into the account, that would be where the revenue comes in for the services being provided, and would be looked at it from a point of view of an accrual basis. That means it completes that transaction, you've issued an invoice, the money has come in, and the amount has been accrued. And then it is being looked at from a point of view of understanding whether it has derived enough revenue to tip the company's transaction into profit, or is it has that not led to the creation of enough revenue which the company is looking at, and that has tipped it over to showing a loss. Now, in a nutshell, if we look at about some summary of financial accounting. Financial accounting would be looking at helping companies assess different aspects of their businesses, and different aspects of their businesses would be coming from profitability, which is looking at income statement, looking at how they've done in terms of acquiring assets or resources, which would be balance of asset and liabilities being shown in the balance sheet, and at some stage on a monthly, weekly, quarterly basis, depending on the size and scale of operation, the company would also be looking at driving, or the management would be interested in finding out how the money is being accrued, what are the revenues the company is generating or the business activities are generating, and that would be used to produce what is called cash flow statements. So these statements, which are produced at a bit of a frequency. So in most cases, if we look at regulatory framework, in most countries, companies are required, companies, charities, cooperatives, various concerns are required to produce some sort of annual statements. And these statements are required for various purposes, for taxation, for ensuring you're providing these statements from a point of view of looking at government regulation. It could be for various stakeholders. It could be for looking at how the company's operations are going. And this would then be produced primarily in these three main forms, and they tend to be balance sheet, income statements, and then, or when I say profit and loss, and then the last would be cash flow statements, which are normally derived or used, on a monthly basis, quarterly basis, depending on the size of the business, in order to understand how is the cash flow situation of the business, or is the activities of the business generating enough revenue in order to sustain the operations. So when we look at the whole concept of financial accounting, we are looking at transactions. These transactions being recorded, they are recorded in different shapes and formats. We look at certain key aspects of it in terms of the foundations of the transactions being done and the way they are recorded using the double book entry keep system. We also look at the accounting equation. We look at what are the major statements being produced and what these statements are utilized for by various businesses, companies, and organizations, would help us understand that why financial accounting is required. Is that okay? Any questions on this so far?
That's good.
Good stuff. Now, let's get into some of the assessment criteria, just to understand and cover some of the indicative content that we need to look at. Now, the first part of this looks at asking us to explain the role of accounting and why is it required in controlling and monitoring, a business performance. So when we look at accounting in general, why some of the bits that we've just covered right now, They are done primarily from a point of view of collating, coordinating, and reporting the data which is related to money and exchange of money-related transactions. So when we look at the purpose of accounting, it is primarily looking at accumulating and reporting the financial information which the business is looking at generating through its transactions. So they could be used for understanding the performance of the business at some stage, if you look at the financial position, we are looking at balance sheet, and in terms of what money the business is generating or what the activities the business is doing, what kind of money it is generating, revenue it is generating from a point of view of cash flow that we will look at. So when we talk about the role of accounting is to produce statements which can be interpreted by different stakeholders in order to understand the financial position of a business. And in doing so, what we look at is when these statements are produced from a point of view of understanding and relating to certain types of standards, so that the interpretation of these statements can be done in a structured and a manner in which everybody can understand. So when we look at the monitoring and controlling side of things, we would look at certain standards and regulatory frameworks which are prevalent across the globe, and those are then followed in order to produce these statements so that they come out with a standardized output. So the two standard organizations that we look at, which is the IAS, the International Accounting Standards, and the IFRS, which is the International Financial Reporting Standards, they have been created. Obviously, there are differences in terms of how they are used and where they are used, but generally IFRS have been introduced and they've been accepted widely in many countries. But when we look at differentiation in terms of how these regulatory frameworks work, more on the US side, we see the gap. And in the European, Far Eastern, and if you look at UK context, we generally see that the IFRS have been adopted by most countries, or the national structures of most countries, in order to develop their own standards, which closely then follow these guidelines and allow these financial data information to be made comparable. So if I have to compare the statement or financial position of a company based in the US with a company in the UK, there are some basic, similarities which these standards allow, which companies need to draw up in producing the financial statements, and that allows that comparison to happen. We'll talk about these in a bit more detail, but basically the controlling side of things is generally done through the regulatory framework, and that is what we need to understand, at this instant. The other means that we need to do is we need to also understand at some stage, I think there is one of the modules which is financial management and control, and there is management accounting. So when we look at, we need to also be able to differentiate what are the differences between these two forms of accounting, the management side of things and the financial side of things. Now, the management side of things would be generally, required when you produce accounts, and they are used mostly internally within the company. So it could be used by management, the board, it could be used by, people who are authorized with the level of access that they have. They would be using this information to primarily make financial decisions or look at producing some sort of a plan or sync it with the strategic plan of the company so that there are enough finances or money available to be able to drive that plan. So this part of the creation of accounts or reporting of financial data, which is primarily concerned with identifying, presenting, and interpreting information, which is used to formulate company strategy or plan for short, medium, or long term, and is essentially required to make decisions, would be what is called management accounting. But when we look at financial side of accounting, what we are looking at is reports, data being produced for external use. Now, whether that's because of any regulation, so if you look at the UK, the Companies House requires the company, if they're registered at Companies House, to produce a set of financial statements which have to be done on a yearly basis, and that is an external usage because of regulation, because of the legislation which is present. And then it could also be produced for various stakeholders. So most companies, when we look at small companies, small, medium companies, large corporations, they produce what is called an annual general report. And the annual general report basically consists of a lot of different heads. They'll have corporate governance, social responsibility, they'll have financial reporting, data on, how they've done vis-a-vis this year to last year, profitability. various ratios, looking at earnings per share, return on capital investment, what assets they've created. Lots of information would be produced. So it is generally done for external stakeholders, for investors, for venture capitalists, for reasons of stakeholders like suppliers, partners, banks, things like that. Now, the reason why some of these are quite important and used is because it helps us control or basically, create information which allows some sort of review to happen at the management level. And that review basically allows planning, and that planning essentially allows, the various important stakeholders in the business to be able to regulate the flow of money or, appropriate finances toward a certain project or certain activities which will lead to creation of more revenue at the company's end. Now, briefly, just looking at giving a snapshot in terms of what would be what is the regulatory framework of financial accounting. So when we look at why accounting is required, and we discussed this initially when we looked at some key, trivia in terms of key terminology. We always record transactions because we want to make sure that anything that the company is buying, spending, or say for example selling, then in those cases those transactions have to be recorded, because at some place of mind they will essentially be looking at dealing with money. And then when we look at from a financial accounting point of view, we need to be able to then utilize these recorded transactions. We have to summarize them, and then at the end of the year maybe produce some financial statements which could be the requirements because of the regulation or legislation in a particular country. So when we look at the UK in particular, obviously there is a national company law, which is the Companies House, that we need to see in terms of producing those statements. We need to also look at some of the EU directives, which are over a point in time going to go away, but yes, they will still be there. And then if companies are trading on stock exchange or if they are listed, then they will also be required to produce these accounts or set of accounts, primarily because of the security exchange rules. So there are lots of reasons why companies need to produce these statements, and that will depend on the size of the business, the scale of the business, and the operations that they're involved in. Now, in terms of looking at the controlling and the standards side of things, specifically in the UK, so we see some origins of this happening in the 1990s when the creation of the Accounting Standard Board was done. Later on, the Financial Reporting Council, FRC, which publishes most of these standards, update these standards. There are consultations which are done through the FRSSC. They look at producing these standards and then implement these standards, which most companies have to essentially follow. And then there are lots of different types of workings of these standards, which is looking at sometimes companies need to create their own standard practices or regulatory practice, and in those cases the SORPs are required. In the case of, say, small companies or micro businesses, or when you look at charities, they would look at adopting some of these standards, and they would be undergoing some sort of a consultation first to the FRSSE, which is a body which then will recommend these to the FRC, and at some stage they might be included as standards for accounting as far as regulations or the importance is concerned. Now, in the first task, so essentially here what we are looking at doing is explaining the role of accounting, why it is required, and at some stage, what we are also looking at is making basically some arguments around why the monitoring and controlling and analyzing of it requires the follow of the standards, and these standards in particular, specifically in the financial accounting, function, and what are these standards. So the mention of IASB, IAS, and also the IFRS would help us, cover this particular side of the task. Any questions on this so far?
No, it's good.
Then we look at the second assessment criteria, which basically talks about, analyzing the conceptual and regulatory framework specifically for financial reporting in the small, medium enterprises. Now, before I cover this task, what I want to do is basically quickly refer to how do we look at classification of companies when we look at specifically the UK. So when we look at classification of these companies, specifically in the UK, we look at 4 different classifications which can typically happen. And these 4 classifications would be, looking at micro entity, there are small businesses, there are medium-sized businesses, and there are large businesses. So when we look at micro entity, this would basically satisfy any 2 of these 3 criteria. That means the turnover of the company is less than 632,000 pounds. Their balance sheet reflects, or the amount of profit the company is generating is less than 316,000 pounds, and they have 10 employees or less. When we look at small businesses, turnover of less than 10.2 million, in terms of assets on the balance sheet less than 5.1 million, and they have 50 or less employees. And when we talk about medium-sized companies, turnover less than 25 million, 250 employees, and gross assets of less than 2.5 million in terms of pounds. And when we say any company which is a large business or a large corporation, their turnover is going to be over 36 million. We look at balance sheet which has assets of more than 18 million, and they have more than generally 250 employees. So an example of a large business here would be, say, Virgin Money. As an example of a medium business would be a small, I would say, restaurant chain that we could look at, or we look at any sort of business which is typically, in the, say, one such business that I can think of is Hello Print, which is a printing business, and they have turnover less than 25 million, less than 250 employees. When we look at small businesses, there are lots of small businesses in the UK, and they are classified as per the government website. There are 3.2 million small businesses in the UK, which are basically the backbone of our economy. So they have turnover less than 10.2 million. It could be a small restauranting business. It could be a grocery shop that a person runs. It could be a post office. It could be, any sort of a business that you have, but it's turning less than 10.2 million in terms of turnover. And micro businesses would be startup companies which have been running in terms of its operations for over a year, 2 years, and their turnover is less than, say 632,000, and have less than 10 employees. So when we look at now understanding, if you know the classification in terms of how the classification is done from a point of view of, companies, and when we say the size of the business, what we also want to look at is understand what is the conceptual and regulatory framework which applies specifically to small, medium enterprises or small, medium businesses in the UK. Now, when we look at, from this point of view, we need to look at understanding what are the accounting standards, what are the rules and regulations which these businesses have to adhere to when they look at producing financial data or financial reports, and what this, when they produce these reports, what kind of accounting standards do they follow. So when we look at the UK specifically, we are looking at following most of the ASV standard, which is the Accounting Standard 4, and the standards which are brought out by the Financial Reporting Council. Now, these accounting standards have been created, with the body which is the International Standards Accounting Board, and their primary responsibility is to create standards which closely mimic the standards which are created by the IFRS. So when we look at, the publishing of accounts which is done by companies and the statements that they produce, they need to be done in such a way that they are following some standard guidelines which are easily interpretable, and it is also allowing the accounts to be audited at some point in time if required under this particular regulation. Now, when we talk about the regulatory framework, and if I look at specifically how they are developed, we need to understand from this particular slide, if we look at this flow chart, the International Financial Accounting Foundation, Standards Foundation, essentially looks at, getting advice from the IASB and the Standard Advisory Council. And in relation with this, it then ends up producing what are called, standards, which are then adopted by various bodies in order to produce financial statements. So when we look at the basic bits in terms of how this tends to generally work, we would see that the IASB is responsible for issuing any new international financial reporting standards which are valid globally. And the IFRIC, which is the body which basically looks at contextualizing these standards specifically to a particular geography or country laws or national laws. And when we look at the Standard Advisory Council, this basically looks at developing any new accounting standards which might be required. So when we look at up until the say early 2000s, we had the classification of small, medium, and large enterprises. But the creation of micro businesses or micro businesses as an entity came about because the SAC looked at that we need to clearly differentiate businesses which are small startup companies, and they need to be differentiated from small businesses, and that is why this term or terminology of micro entity actually came about. So when we look at some of these fundamental changes which are introduced in order to meet compliance, in order to look at changing times in terms of how businesses and organizations are operating, they are then advised by the Standards Advisory Council, which looks at creating these new standards in consultation by printing, white papers, and consultation is done with confederation of, say, CBI, as we call it. We have lots of other organizations which play a part into this. And at some stage, when they are, released and then become a part and parcel of the workings, would then be done through the IFRSE. Now, there are lots of accounting standards. I've only done a screenshot of some of the standards that we see sometimes to understand, because there are lots of them. So as accountants, as people, when we look at preparing accounts, sometimes you'll have to look at referring to some of these standards to ensure that the statements being produced are accurate, factual, and reflect the practice which is required in order to, provide that information. So when we look at companies, sometimes when they receive government grants, for example, grants which are released. So if I take a practical example, last year, when we're still in the pandemic, but when we look at last year, the government actually looks at introducing some grants which were given to businesses in order to, tide over this, times in terms of if you had a premises which was leased or rented and things like that. So depending on the size of the business, the government actually released grants for all companies which were paying rates or, paying rents or had leased premises. So if you were paying rates up to 22,500, you receive grants of up to 10,000. If you're paying rates up to 55,000, then you receive grants of up to 25,000. And then depending on if the size of the business was large, there were grants given out to other businesses in order to, help them tide over, the costs which are related to leasing and rental side of things. So when we look at accounts being produced for last year, in some cases when companies have received grants, accountants will be required, or when you look at producing these statements, you will be required to follow some of these standards, and these would have to be reflected appropriately in the statements which are produced, like the profit and loss and balance sheet, and they would be following some of the accounting standard practice and the standards which are there, from a point of view of preparation of these accounts. So if you've received grants, or if you say, for example, under the European Union, a lot of small businesses or micro businesses also receive, relief on, say, for example, PAYE or national insurance contributions, and that is a one-off grant which some companies receive. So when you look at that, you'll have to look at following the appropriate standard to be able to report that in the statement, either in the reflection in the statement or as some notes which are prepared when these statements, additional notes have to be mentioned when these statements are being prepared. So there are some, standard accounting practice, let's say, acts that we need to follow. And then there are standards which are for financial reporting. And there are some of these which I've just summarized for the purposes of understanding that these are basic standards which need to be followed when you're producing appropriate statements from a point of view of reporting them into, financial reports or financial statements which are produced. So this bit would be the coverage on understanding why a conceptual and regulatory framework is required from a point of view of reporting, for SMEs. And I put in one of the slides here in terms of why there is a need for regulation. So this directly answers that particular task to say, I'll put that slide, behind this itself. So it basically explains why there is a need for regulation. So regulation could be done primarily to ensure that the government is able to receive, say, appropriate tax from companies or organizations when they produce these statements. They could also be produced for the purposes of, as I mentioned earlier, for various stakeholders. So sometimes when you look at companies producing these statements, they are also looking at, giving out dividends or giving out, for example, bonuses or incentives to management and various shareholders in the company. So in those cases, also they have to be reflected on these statements, and that's why they are also required. And if the companies are trading on stock market, they are listed, then obviously they are also requiring this to be published, because at some stage earnings per share or some sort of dividend which is declared for its shareholders would be also reflected in these statements. Last but not the least, there are lots of other reasons why. So legislation and regulation would require these to be produced and followed. And last but not the least, if there are companies which are having operations in the UK and you have a company which is having operations elsewhere, so the production or the preparation of these statements are required to be done in a way wherein they are interpretable, they are relatable, and they reflect the true position of the company in terms of its finances. And that would be requiring the following of laws and standards which have been set by the IASB, and if it's for international reporting outside the UK, you look at probably IFRS, and if it's in the US, you're looking at producing them following the GAAP standards which are required for these statements to be produced in those days. Any questions on this?
Yes, fine. Will all these slides, these all actually appear in the Moodle?
Yes, they would. They would.
Okay.
So the copy of this recording and this presentation, which is the updated one, will actually appear on Moodle in a couple of seconds just after this session has been completed.
No problem.
Now, the third criteria is basically looking at, why do we need to review and look at accounting principles in particular when we are looking at preparing these financial statements. Now, some of the reasons why we need to review and, obviously look at incorporating them is because we need the companies, when they produce financial data, they have to follow some standards. So generally speaking, when we look at IFRS in particular, these standards were adopted by the European Union in 2005, and more or less, most countries are actually adopting these globally, and that allows again some sort of standardization to happen when we look at comparing, financial related information about companies, in different countries. But in the UK in specific, we look at, the IASB, which is what would be primarily the reason of, the body which actually reviews all these principles and standards, and that is what we are basically going to use to be able to produce, the financial records. Now, some part of this, when we look at, why they are to be reviewed and why they are to be produced, we need to look at, again, the main reasons being that these statements are primarily produced for a number of reasons and for a number of different types of users. So these users could be investors, lenders, customers. Sometimes an example of this I would give you is that if you are looking at taking out a loan and the company is taking out a business loan from the bank, then obviously the bank would want to see what kind of revenue the company has been generating, what is the profit, what is the cash flow their business generates, and basis that is what they're going to make some decisions. So these statements, in some cases, when you take out loans in particular as a company, have to be audited, right? Because if the percentage of the loan or the amount of loan that you're looking at or the amount of money that you're looking at borrowing as a company is greater than what the business can actually predict, then in some cases the accounts have to be audited by auditors or registered auditors, and what that allows them to do is say with confidence that, okay, because these are audited accounts, there are no irregularities in what has been reflected in terms of financial information, and what the characteristics of the business are absolutely what the company is showing in the statement, and that allows the bank or lending institutions to get confidence, and then they are able to lend money. Now, sometimes they'll ask you to produce cash flow statements just to see projections to the cash flow statement, so that they are able to understand, what kind of revenue or business would the company be generating, and is this going to be enough for the money being generated, required to be borrowed, to be able to repay that back with some interest costs or, with capital and interest costs in the future. So when we talk about the concept of reviewing these financial standards and principles, we basically also look at some of the other concepts which are apart from balance sheet, income statement, and cash flow. And we talk about some of the terms which we recognize from a point of view of when we do notes, specifically in producing these statements. So when we say going concern, when we talk about accruals, consistency, materiality, we talk about substance over form, and we talk about prudence. These are terms which we have to use primarily in the notes for these statements being produced. So a going concern would mean the business is continuously running, the operation is ongoing, it is not a dormant company, it is not going into administration, but it's a business which is, obviously growing and, continuing to operate. Then we look at accruals. So money which is being accrued in terms of income and expenses which the company is doing, but at some stage, what cash is being received, how is it being accrued, what activity is it going against, is it a revenue or an expenditure, that would be put into, various statements, and that would be related to accruals. When we talk about consistency, we talk about the consistency in terms of the reporting of these transactions in financial statements year on year. So when we say sometimes if the company has bought a large piece of asset or machinery and they would look at creating depreciation or claiming depreciation every year, then this is reflected in the same consistent manner over the years for the next 3 or 4 years when they look at claiming depreciation, and that would show consistency of reporting the transaction in the statement. Then we talk about materiality, which is primarily looking at the information which is required to be stated and it is not omitted. So sometimes when we look at companies looking at financial irregularities or reporting of profit, not declaring certain transactions, then that is where materiality comes in, because it is important and required by law for the company to be able to report all transactions. And in terms of if there are omissions which are done, they need to be explained through what are called the explanatory notes and why these omissions have been done. Substance over form, that means you are basically going to record transactions as they happen. It is going to be recording all commercial transactions, which basically means that there are transactions which are not financial or might not be required, could be explained in the notes rather than recording them on two statements, which would create discrepancies in terms of how the accounts or the position of the company is actually reported. And when we talk about prudence, we talk about the inclusion of degree of caution while making projection statements. When sometimes when you look at companies, specifically small medium enterprises, looking at giving projections or statement of cash flow for 6 months, 1 year, 12 months, 18 months, 24 months or beyond, then the idea would be here to look at including doing those projections with a bit of a caution to say that this is the optimistic side of things, and this is the not being overly optimistic, but being factual and as close to what the business is going to do or generate should be actually looked at reporting. So when we look at reviewing and when we look at the principles through which we look at reporting these transactions, we need to cover these 6 broad terms, and in relation to the standards in the UK, which is IASB, and that would help us cover this particular task. Any questions on this?
Yeah, that's good.
Last one is the merit criteria in this particular learning outcome, where we need to talk about the importance of how accounting concepts and principles are important, and why they are important when we look at essentially including them in the financial statements. Now, in this slide, if we look at, there's a bit of a snapshot that I've prepared, which is to say how, why regulation is there, what are the different types of regulatory framework, how they come together, what are the objectives they define in terms of producing financial statement. But when we talk about the main part of this task, which is the principles which are required to be followed while preparing financial accounts, are these principles. So we need to make sure, if you're an accountant, if we are basically producing or working within a company in the finance department or looking at producing statements, then when we look at following some basic fundamental financial principles to produce these statements, we would need to look at relevancy, we would need to look at reliability, comparability, and understandability. And those are the principles that we need to talk about because they depict what are called the qualitative characteristics of financial statements, when you look at certain records. So if you pick up a balance sheet or a profit and loss account or an abbreviated account for a particular company, what you're looking at is how they have been prepared, what care has been taken to, or what guidelines have been followed in order to look at preparing those records. And in these records which have been prepared, do they provide relevant information to interested parties? And these interested parties could be investors, it could be banks, employees, shareholders, government, and in some cases members of general public. Now we know that obviously in Companies House, most of the accounting information is open. Most companies report accounts in the abbreviated form, so some sort of information is available in the public domain. And when these accounts are prepared, most people looking at preparing these accounts or financial statements need to look at these qualitative characteristics so that they conform to the basic standards which have been set in terms of preparing these statements. And that is what, when we say qualitative characteristics, these are the 4 big principles that we need to follow to be able to produce these statements. And I've defined them in slightly more detail on this particular slide. So this task will essentially, is focused on understanding what is the importance of following these principles, the qualitative characteristics of the principles in producing these financial accounts, and that is what will help us accomplish the merit side of things. Any questions on this?
No, it was good.
Good stuff. So lastly, I've put in a small bit of quiz just to see what we've understood, what we've covered today has been understood. So some fill in the blanks with regards to the basic bits in terms of the bits that we have covered in some of the slides. So here the first question, if I quickly go through them, would be financial accounting is focused on what area of financial statements in the company, external or internal? Financial accounting is focused on what type of financial statements of the company in terms of whether it's required to be produced for internal purposes or external purposes. So the answer is between either external or internal. So when we looked at management accounting and we looked at financial accounting, so management accounting was produced for
internal.
So financial accounting will be for external purposes. So that's the right answer. Corporations whose stocks are publicly traded must have their financial statements dashed by the independent certified public accountants, or in this case, the ROC, Register of Auditors. So what would be the fill in the blank here? In this case, audited.
Audited.
Yeah, audited. Yeah. So that's the answer. So GAAP stands for, in the US, we looked at this in the initial video that we started off with, generally accepted
accounting principles.
That's correct. Now, dash is the entry bookkeeping, which results in at least 2 accounts being involved, or 2 sides of the transaction being recorded in every double entry. Double entry. Every transaction will have 1 account being credited and 1 account being
debited.
Accounting equation debited. So we look at the accounting equation debited. And the accounting equation is assets equal to dash plus stockholders or owners' equity or equity.
And liabilities.
That is correct. So accounting equation, which was primarily quite important. So liabilities plus equity equal to assets. And the other last 2 are the profitability of the company for a specified period of time is reported on dash statement. So where do we record the profitability of the company?
Well, it's either the income statement or profit and loss statement.
Income statement. The main components or elements of income statement are, we've studied or looked at 5. So you look at assets, you look at liabilities, you look at expenses, costs, and the last one was revenue.
Mine's gone blank. Revenue, of course.
Revenue. So we covered this in the initial slide, just looking at where it was. But yeah, those were the 5 that we normally look at: asset, liability, equity, revenue, and cost. So it was revenue.
Yeah.
So I think this basically covers, what we wanted to look at in particular, with regards to all the indicative content through this slide. So we've understood the reasons why accounting standards have been created. We've looked at the importance of and the role of IFRS and the IASB and the FRC, which is the Financial Reporting Council in the UK. We've looked at the main bits of how the origins of financial accounting started with the double book entry system. We look at the accounting equation. We also look at the various type of statements which are produced: balance sheet, profit and loss, income statement, cash flow statements, which normally would be consisting of what we understand in a nutshell is financial accounting. And then some of the principles which are used as notes sometimes when we explain the accounts, these 6 terms that we talk about, and then what are the various principles which are used in order to, or observed in order to produce these statements, would help us cover the entire remit of the first learning outcome. Is that okay?
That's brilliant.
Good stuff.
Trip down memory lane.
I could sense that, absolutely. That's why I mentioned in the start, I don't want the presentations to be quite basic, because a lot of us have a lot of experience in doing the accounts and have been working in this profession. But, some of these are prepared from a point of view of looking at you doing the assignments at some stage. So hopefully the slides would directly relate to what you're going to be covering, and that will hopefully make it easier to,
Also, I noticed on the Moodle, you've actually put a load of content on there, and you've actually got some Pearson, Frank Wood manuals. You got everything there. So I'm pretty impressed, Raman. It's excellent.
No, that is the case. Because we've been doing this for a number of years. So I think from our point of view, what we want to do is, when learners are studying with us, especially because it's assessment based, what we don't want to do is basically have learners go on to Google and other places to get work into the assignment, and that leads to plagiarism. So the idea is to try and provide pretty much everything within the system, so you are able to then follow the unit and hopefully achieve it with the grade that you're looking at doing.
That's brilliant.
These books are recommended resources that we provided, so that when you look at specifically, there's lots that I've covered in the slides. We try and keep it as brief as possible, but practical limitations being that everybody is working, family, kids, job pressures, they only end up studying the slides that we show. And that's one of the reasons we try and, make them quite detailed. So it relates to what is to be covered and hopefully gives you some understanding in terms of the topic.
And the idea is we can get through one of the modules probably every 4 to 6 weeks. Is that right?
That is correct. That's the whole idea. So we do them by learning outcomes, and the basic bit of this would be to try and cover 1 or 2 every week, and that allows the units to be completed in about 3 to 4 weeks generally.
Perfect. So we've got a session tomorrow as well?
Yeah, we've got a session tomorrow as well, same time.
Okay, that's brilliant. Thank you very much, Raman.
Thank you, and I'll catch up with you tomorrow.